guys, it's Vivian, your hot stock girl. Today I'm going to do my best to explain the most common financial terms used by professional investors. Since my goal is to make us all better investors, please share your knowledge of EBITDA in the comment section below. In just about every stock video, I discuss EBITDA. EBITDA is an acronym that means earnings before interest, taxes, depreciation, and amortization. Now that I said all that, I'm sure you know exactly what EBITDA means now. Okay, I'm just kidding. But it is extremely important for individual investors to understand EBITDA, so I will try my best to break it down for you. The E stands for earnings. In general, total sales minus expenses related to those sales equals your earnings. The expenses include the cost of the products that were sold and the expenses related to employee expense, rent expense, management salaries, and overhead. So the earnings in EBITDA are essentially a company's gross profit. The I in EBITDA stands for interest expense. If a company has no outstanding debt, then the interest expense would be zero. Companies that have issued bonds or have bank debt have to pay interest to the bondholders or the banks. And this is the interest we are talking about. The T in EBITDA relates to the corporate taxes that the companies pay to the federal and state governments. The D and A in EBITDA stand for depreciation and amortization, which are non-cash write-offs that companies are allowed to deduct from their taxable income to arrive at their net income. So why use EBITDA when you can just use earnings per share to value stocks? For years, all of the great money managers like Peter Lynch and Warren Buffett used earnings per share to value companies and had tremendous success doing so. But earnings per share valuations leave out all of the great companies that show a loss or have significant amounts of write-offs on their taxable income. Warren Buffett never bought Amazon, probably because Amazon didn't have positive earnings per share. One of the smartest investors missed out on one of the best performing stocks in history. If you wait for a company to show strong earnings per share growth, you might miss out on huge opportunities for stock appreciation. When you read any of the conference call transcripts, you will see management discuss EBITDA. Money managers also use free cash flow as their basis for making their investments. Free cash flow is basically EBITDA minus capital expenditures, or CapEx. For now, just use the word EBITDA to mean a company's gross profit and look for companies that are showing strong EBITDA growth from their business operations. Investors don't care about EBITDA from a one-time event like the sale of a business division. It is only EBITDA from the actual business operations that matter. If gross profits or EBITDA are growing better than expected, the stock will go higher. If EBITDA is declining, investors tend to sell those stocks. Understanding EBITDA may take a while, but you must become an expert or you will never really understand the stock market investing. So there you have it, my explanation of EBITDA. Let's keep the EBITDA conversation going in the comment section below. I'm Vivian, your hot stock girl, and please be sure to subscribe below and check out my other videos for more great investment ideas.